I have the pleasure of welcoming everyone to the latest ASA live webinar with the title, Africa's Debts Freeze, Forgive or Forget. I am Boason. No doubt this is one of the hottest issues being discussed here on the African continent and around the world, in particular by the G20 nations of creditors to Africa on one hand and China and other creditors on the other. As of today, there is no consensus yet on how to resolve Africa's debt portfolio, even in the face of the coronavirus pandemic and the wide ramifications it have on the economy. So Africa is yet at another crossroad. I am Boason once again, and I am a senior consultant at New Markets Media and Intelligence. We work with researchers, media, governments, and business enterprises to increase understandings of business activities in frontier and emerging markets. Our hosts for this seminar are ASA, Africa's leading non-bank currency broker dedicated to keeping free trade in Africa on the agenda. Today's webinar will delve into some of the most critical and pressing aspects of Africa's debt relief implementation. So join me in bringing on the show the panelists. Please welcome Elizabeth Rossiello. She is the founder and CEO of ASA, which started off in Nairobi, Kenya in October 2013. Elizabeth is one of the leading voices on how to support financial innovation, especially in the foreign exchange and treasury markets, as well as payment systems across frontier markets. Elizabeth started her career in investment banking, and she has trained regulators on best practices and analyzed investors and institutions entering into African markets. Good afternoon, Elizabeth. It's good to have you on the program.
Thanks. It's great to be here, and I'm excited for today's discussion.
Thank you. And also welcome Joseph Rohm. Joseph is the managing director and fund manager at Adventis. Adventis is an Africa-focused investment firm which he co-founded. He is the portfolio manager of the Africa Equity Fund and Pan-Africa Equity Fund, and sits on the investment committee of the Africa Enhanced Income Fund. Joseph has over 20 years of investment experience in Africa and Middle East. Good afternoon, Joseph. Welcome to the show.
Thank you, Boason. Thank you very much. Looking forward to the discussion today. Thank
you so much. Let me also welcome Dimieari Von Kemedi, who is the co-founder and managing director at Alluvial Agriculture. He's a Nigerian entrepreneur. Dimieari has served in a number of senior expert positions, including with the UNDP, the UN panel of experts on Liberia, Statoil and Haas School of Business at the University of California. Von is the co-founder of Alluvial Agriculture, which is a private sector initiative looking to support Africa to feed itself. Good afternoon, it's good to see you.
Thank you very much, good to see you again.
Von, thank you. And of course, after the panelists, we'll have a closing remarks from His Highness Muhammadu Sanusi II, the 14th Emir of Kano. He's an Islamic scholar and of course a professional banker, and this governor of the Central Bank of Nigeria between 2009 and 2014. Muhammadu Sanusi brings a very long resume to the table, but a very important aspect of his profile was that he was appointed the Central Bank governor in 2009 for Nigeria, a very trying moment during the global financial crisis and the banking crisis in the Nigerian system. Sanusi, after about 2 years in office, was awarded the best banker, central bank governor in the world by the Bankers magazine for the year 2011. That experience is bringing to bear at this critical point in time. Good afternoon, Your Highness.
Good afternoon, Boason, and I'm glad to be part of this panel as a guest panelist.
Thank you very much. So, thank you, ladies and gentlemen, and our participants around the world joining this. Let's get started with a few ground rules of engagement. The webinar will address some of the questions from our very significant number of participants, but you can post your questions, which will be available. We'll try as much as possible to take some of them during the show. In order to make this very interactive, please share your name and your organization, and if you choose to remain anonymous, you can do so. Meantime, this seminar is strictly under the Chatham House rules. So for my colleagues who are journalists joining this webinar, please remember that we are prepared to answer your questions and provide further guidance. Do get in touch with us, and we'll be happy to confirm or arrange any follow-up to the questions you may wish to ask any of the panelists. Remember, this is strictly Chatham House Rules Live webinar. So let's get started by posing a poll question, which is coming up right now on everyone's screen. We'll take the results at the end of the show. Very quickly, so how do we do it? What's the best approach? That's the top question. What is the best approach for Africa's debt negotiations? You have about 5 options. How do you think we should deal with this? Should we go unconditional debt forgiveness or cancellation, which is forgive and forget? Or we should forgive or cancel this debt with conditions, what you call the carrot and stick approach? Or should we reschedule to delay capital repayment but at full value? How do you vote? The 4th option, reschedule to delay interest payments only. Or finally, keep the status quo. So let's get started. Just within the last 48 hours, we've seen some developments within the Africa's debt space. China moved in to reschedule Angola's $20.7 billion debt over a 3-year period. Meantime, Reuters reported this afternoon that a group of bondholders formed a group to discuss Zambia's external debt. So let me start question to the panelists. Of course, the polling is on, as you can see. Keep voting in, and we'll look at the results on the Twitter poll at the end of the show, as I said earlier. So let me just get on this the first question to Elizabeth. How do you balance, Elizabeth, this is for you, how do we balance the need for a relief against a history of a moral hazard of debt payment for a number of African states?
Right. Thanks, Boason. And, you know, I think we have to go back and really look at our reputation in Africa and whether it's truly earned or it's biased. I mean, I think it's interesting to take the example of Argentina and Angola as an example. As we know, both have received international debt multiple times. Argentina reneged on its debt 9 times in the past, yet even so, bondholders kept being rewarded. 3 years ago, again, first time any junk-rated country has sold bonds with no repayment required within a century. And yet in Angola, we haven't defaulted since the end of the civil war in 2002, yet bondholders are charging a higher rate of over 9%. So is there some sort of truth in this reputation of bad behavior, or is it more of a bias against African markets? So number one, I'd like to clear the air a bit and understand what is really the lesson learned and how much discipline do we fear we are losing by giving debt relief. We're seeing that this is a once in a lifetime situation, and all over the world debt is being canceled. So to hold African markets and economies to a more stringent requirements, I think is more than a little unfair. And I was happy to see Macron, and of course we know France's history on monetary policy with West Africa, so it's a little ironic, but we see him today urging forward for that debt relief. And I think it's more than fair. I mean, when the volcano smoke occurred a few years ago and Kenyan airports were closed for a week, the flower market, which is an essential part of the economy, was hit tremendously. We are now 3-4 months with airports closed. So export economies really have no chance to get back in a normal way unless we do this. So I think the first question is to ask, how fair is it to say that discipline will be lost forever if we forgive debt? And for that, I think that that's an unfair statement. And number two, what will happen if we don't cancel the debt? And I think the mountain is too high to climb in a lot of ways. This is, like I said before, to get out of the hole that a lot of these markets are in, a lot of these exporters are in, it's going to take some time. So really, there's no other option.
Interesting. So, Joseph, what's the lesson of history for you here in terms of Africa's debt implementation, debt cancellation, debt forgiveness? Do you think the previous experience of previous debt program. For example, look at Nigeria. During the Obasanjo's administration, there was massive debt cancellation for Nigeria. Do you think that African governments have been able to reward reward these debts forgiveness, or you've seen you've seen experience in terms of fiscal largesse, sending a green light for state capture, corruption, and what have you?
So maybe firstly, just to say, I agree with Elizabeth. I think there's enormous bias around how Africa's debt should be treated. But I think, I mean, you asked about lessons from history. I think one of the things one must be aware of is that the situation is different. You know, the reality is that Africa's credit market is much more complicated than it was in the early 2000s when the HIPC and the Paris Club granted debt relief. And effectively, Africa owed money to wealthy countries only and multilateral organizations. The creditor landscape, as I said, is much more complicated today. Private lenders own, over 30% of Africa's debt. China owns 20% of Africa's debt. And I think you need to differentiate. I don't think anybody would argue that Africa doesn't need short-term debt relief. But I think long-term debt relief is unlikely. And I also don't think that debt relief is the only option. You know, I think one can differentiate between concessional loans and commercial loans. There are many interesting examples. One that comes to mind is China's loan to Ethiopia for the Addis-Djibouti railway line, where payment terms were just pushed out by 20 years. Concessional loans to ports, that debt was just converted into a lease. So I don't think one can make a sweeping statement about blanket debt relief, because I don't think it's easy. And also, there are many different creditor requirements today. And then I suppose the final comment from me at this stage would be, what are the implications of long-term debt relief? And is that actually the best way to attack poverty and development going forward? And I would say no, but we can come back to that. Yeah.
Thanks, Joseph. Let me ask Von Kemedi, how do we ensure or enforce responsibility on debt during boom and bust cycles, in particular for commodity-driven economies on the African continent, Nigeria, Ghana, Angola, DRC, Mozambique, South Africa, and others?
I think a very critical factor is what the debt is applied to. If we take debt to supplement our budget, that's not a very good and sustainable way to manage or utilize debt. Much of the debts that are tied to infrastructure, carefully calibrated, can be managed. Because, for instance, the railway contract debts will be paid for by passengers. So at the end of the day, what's important is to make sure that the economy is robust enough, to manage those debts. So bondholders and countries that extend debt or even debt relief to African countries must have an agreement with the government that the debts will be channeled strictly to specific projects that can support repayment, rather than being used to supplement general budget, particularly in the face of expensive government.
Great. So if that is the case, let me ask you, Elizabeth. So what about the speed of execution of infrastructure projects on the African continent, Elizabeth? In terms of building roads, rails, electricity, things like that. For airports and other infrastructure. Do you think, yes, projects are tied to debt, but again, what about these projects being delivered on time to be able to pay back on this debt and provide benefits to the people?
Great. Well, I'm a disruptor by nature. So I do think larger projects with run by larger organizations tend to go slower than more of a disruptive innovator. So we saw in Kenya, for example, the Turkana project, which was incredibly large with a lot of stakeholders, take almost a decade to get off the ground. Yet in the same time, we saw many mid-sized renewable resource projects blossom and go to fruition all over the region. So similarly, what AZA has done and what the business I have built is we've started a trading desk to be able to match the needs of importers and exporters and really create that liquidity in that secondary market. And what we're able to do is provide a better service and a faster execution than a lot of the larger organizations. And in times like COVID, where traditional infrastructure, traditional organizations struggle because they're brick and mortar, because they have old-fashioned management styles, we've really seen mid-sized businesses take over. So, there's been a lot of crowding out of the SME and the mid-sized businesses. And I'm not talking smallholder farmers. I'm talking real mid-sized businesses that have driven the economic boom in a lot of European markets, South American markets, East Asian markets, have been crowded out of government contracts, have been crowded out of licensing, have been crowded out of available opportunities all over the African continent. And I think if we let some of these competition in and we let some of these smaller players in, those that don't have uncles and fathers in parliaments, still licensed, still compliant, still large enough to execute, I think we'd see a radical change in the completion and level of execution. What we're really missing is competition in these markets. And, the Nigerian electricity sector is a perfect example. More electricity than needed in Lagos is generated, but the transmission of that is the problem. And there's tons of solutions all over the continent, all over the world that are really not being allowed to kind of enter that market and give it a shot. So I think, again, how do we open the door to more competition? And we've seen innovation and technology and entrepreneurs in huge amounts all over this continent. This continent is just birthing entrepreneurs. I am one tiny example of what's been happening across the continent. And I think we just need to see them welcomed in. So I'd love to see international financiers also, at the government level, include these SMEs, include these mid-sized businesses in government contracts. And really, let's see that as the change and push forward more transparency and also more competition.
Interesting. I appreciate that so much. And we're getting some of our participants says, thumbs up to you, Elizabeth, for bringing the Africa's SMEs into the debt conversation, how they can benefit from these multilateral loans and all of that for small projects that really goes down the bottom of the pyramid to create jobs and prosperity for Africans. Let me ask Joseph to expand on his earlier comments. It's complicated right now, like you said. What we are dealing with is different from the HIPC period of the 1980s and the early 90s with the IMF, highly indebted poor countries. So how do we balance what you call the sovereign debt forgiveness on one hand and the bondholders on the other hand? Now we have a group, according to Reuters, what I said earlier, a group of bondholders have formed a group of their own to have conversations with Zambia. So how do we untangle the corporate side of debt, which is much bigger than we had in the 90s on the continent, vis-a-vis the sovereign debt overhang?
Sure. So I suppose, what I'm saying is that the debt relief frameworks of the past aren't appropriate for the current situation because, as I said, the creditor landscape is much more complicated. And I mean, you're correct in the sense that getting disparate lenders to agree is much more complicated, particularly bondholders. And I think, again, you ask a very broad question, but in reality, there are huge differences from country to country in terms of their performance and their need for debt relief. So I would argue you need to look firstly on a sovereign by sovereign basis. Some countries desperately need debt relief, and you can see which ones they are. The IMF has provided rapid financing facilities at very short notice, but others don't. Some are doing well. You mentioned Zambia. Zambia is an underperformer. But maybe what I can do is link your question to Elizabeth's comments about the SME sector, because I think one of the risks of debt relief is further damage to the growth of capital markets in Africa. And Africa is desperate for capital to feed entrepreneurs, to feed companies. And, we've had some success. I mean, the Eurobond market has been an enormous success. But local currency bond markets raising local currency funding from international investors and public equity markets have grown at a dismally slow rate. And I think, that is one of the dangers of talking of blanket debt relief, is you damage the potential growth of capital markets at a time when African corporates in particular need access to capital probably more than ever before. And that's also because the African continent is performing much more strongly than it did 20 years ago. Africa is one of the few parts of the world that is delivering strong growth, after Southeast Asia. So there's this huge need for development finance and capital to grow businesses. So again, the situation is different.
Yes, it is. Vaughn, I haven't forgotten you there, so just give me a second very quickly. I just want to ask a corollary question, a follow-up question with Elizabeth on what Joseph just said about the implications for the debt market. Yesterday, the CEOs of two African banks, EcoBank and Equity Bank in Kenya, says they're not in support of outright debt cancellation for Africa. So what's your line of thought with what Joseph said about the implications of outright debt cancellation or unconditional debt forgiveness for Africa?
Well, I think, they're speaking to the fear that was already mentioned, that the debt forgiveness is used for inappropriate purposes, so supporting currencies that should be free floating, bolstering up government budgets, crowding out the growing private sector is a real problem. And EcoBank and specifically Equity Bank are the real champions on the continent, showing how true private brands can grow and serve this market. And they're some of the first super brands that have come in, replacing a lot of international, poverty debt or, development debt. And working with a lot of the development institutions, it's awesome to see EcoBank and Equity Bank and a lot of their peers move in and take some of those pipeline investments. And I think the comments there are in that vein of fear of using it for the wrong reasons and crowding out the growing sector. And Kenya has been a banking lion the last decade, really showing how the private sector can move into that space with other countries to follow. And again, it's really hard to generalize over the 50 plus countries across the continent. There are some winners and losers, but just quickly on that mention about local currency funding, we saw in 2019, I believe Zambia was the first to change its international, its dollar debt with China into yuan, into local currency debt. And I think that's a great tool to use to not only show that there's a demand for that, but that it can be done. And it, the price is what the market will pay. And if Chinese investors will pay it, then that's the price. And there's a demand there for that. And I think we've been so stuck in our ways for so many decades saying, absolutely not. There's no demand for African currency lending. There's no demand for the use of African currencies, even from central bank governors and even from governments who have said, no, nobody wants these local currencies. And I think let's use this as an opportunity to let go of the dollar a little bit and to understand, can some of the debt be restructured using local currency financing? And I think that's an interesting tool and an interesting thing to explore. And I would love to see Equity Bank and EcoBank issue more local currency funding, because even their growth has been based on some dollar funding. And You know, they're a drop in the bucket about what we need on the continent for local currency financing.
Elizabeth, you're the person that says who follow the money. You want to see where the money goes in practical terms. I like that. So we're going to bring in China into the conversation, but just about 2 minutes, let me ask Vaughn about how we're going to alleviate poverty and hunger on the African continent and bridge the inequality gap. The World Bank and the IMF have spoken about how this COVID-19 pandemic will widen the gap between the haves and the have-nots, especially in developing countries. So some of the engagements from Washington had been for countries in sub-Saharan Africa and the G20 as well. So what are your thoughts about why this debt forgiveness or debt cancellation or repayment with certain stick and carrot, whatever approach should be to deliver, to make sure that Africa don't see an expansion of the hunger, the poverty index, and other parameters that have been haunting the continent for such a long time?
I think I'll build on what Elizabeth had earlier mentioned, which is the need to pivot some of these resources to the small and medium scale enterprises. If we do that, then a lot of people will be employed, the economy will be stimulated, there will be more jobs, and we'll be able to manage the shocks from COVID-19 and the commodities, low price of African commodities right now. So what we need to do going forward is to channel a lot of the resources, the investments coming into Africa more broadly to the private sector and particularly to the small and medium scale enterprises because government is not managing the business side of things very well, and that's not really their own side of things. So we need to see these debts going more to infrastructure. When it comes to government debt, going into infrastructure that will support business development and more investment going into businesses. So the infrastructure debt can be repaid through the monies that will be channeled towards, for instance, if it is rail, towards transporting of goods and people. When the economy is robust enough, then people will be able to pay for this infrastructure, and that will effortlessly go into repayment. So the emphasis really shouldn't be so much around debt forgiveness, but managing these debts in a way that does not put too much pressure on the economy, so that those who extend debt to Africa will be confident that if more debt is extended in the future, it will be repaid. But more money actually needs to come in to make the repayment possible.
Interesting. So let's, Joseph, let's bring China into the conversation. This is a big elephant in the room. So how significant are China's debt relief commitments so far on the African continent, and how should we treat China within these debts for Africa's cancellation, forgiveness, unconditional forgiveness, whatever it is, debt implementation program? What's the role of China here? What do you think China would want to achieve that could be significantly different from what the G20 and what Washington institutions would want to see?
So again, you know, China now owns just over 20% of Africa's external debt. So it's, you know, in the last 10 years, it's become the major lender on the continent. I would say China's probably got a very nimble approach and has actually been renegotiating debt over the last 10 years. You know, we know they've renegotiated debt with Ghana, Zambia, Angola fairly recently. What we don't have are the details around that. I think China, and I gave you an example earlier where they renegotiated the terms of the loan they'd made to the Addis Djibouti railway line in Ethiopia. They've been very good at restructuring loans to ports and turning those into 99-year leases. So China has a very open approach to restructuring its debt. I think China would be looking at this mountain of debt at the moment and saying, we'd be very happy to restructure more debt. But again, we don't want to be the only ones doing it. We would want to do it alongside other multilateral and bilateral organizations. Why should we be the only ones restructuring debt? But as I say, they've got a recent history of being very nimble and flexible. And again, I think the question is not so much that debt forgiveness is the only option, because it's not. I think we will see significant restructurings, refinancing, and debt for equity swaps, et cetera, et cetera. And I think China will probably be at the forefront of a lot of that.
So it's very interesting. So Elizabeth, let's go to this conversation around whether we should delineate some of these debt conversations and implementation from country to country and all of that. So which countries do you think are handling their debt position excellently well? What should we be concerned about, and why? Do you think we should cherry pick, or the creditors, the G20, China, and others on bondholders should cherry pick countries, and on what basis do you think that should happen?
Well, I'm not sure I'm prepared to go country by country and give them each a rating, but what I would like to go back to is what Dimieari said about separating the use of funds. And I think what would be very interesting is if we stop talking about each country's needs and talk about the segments within those countries. So there's a portion of the economy of every one of these countries that truly needs complete debt forgiveness, and if not debt forgiveness, even direct cash transfer. And I worked in microfinance for many years when I first moved to Kenya, and what we've seen many times, DFID has proven this with study, a lot of companies in this space have proven this, economies and sectors of the economy that were truly devastated by COVID, the best use of funds is direct cash transfer. And that again helps prevent the co-opting of, misuse of funds. And once we take that segment out, then there's a much healthier part of the economy, whether it's SMEs or active, who can have a more restructured space. And then again, there are leaders they're able on the international markets to source funds that maybe shouldn't have that debt restructured. So I think it's very hard to talk about, country by country. I think it's more important to look at the breakdown of the economy in each of these countries and understand what is the segment mix. Not to sound like a startup, but we talk a lot about what's the segment mix per economy. How much of Nigeria's issues need to be solved by true cash transfer? How much can be solved by restructuring? How much should probably go into local currency funding? And how much should be available? I mean, we've seen this in the United States with stimulus packages being used by investment banks and CEOs of Amazon, for goodness sake, who are becoming trillionaires during this crisis. It's just not appropriate to give one answer for the United States, because segments of the economy are hit wildly differently. So I'd love to be able to talk about that a little bit more. And I think what's interesting when China comes into the situation, China doesn't have this legacy. It doesn't have this colonial monetary colonization of African legacy. And they can really look at it with fresh eyes and a more nimble view. And they can go one-to-one and look at the use of funds for specific infrastructure projects. And we haven't seen that nimbleness from other international lenders, partly because we have this whole development structure that's been built up that's very difficult, which doesn't believe in segmenting. We see development institutions give development loans to equity bank and to farm cooperatives, the same development loans. An equity bank has a very different use for that than a farm cooperative. And there hasn't been that kind of segmentation. And I think that would create a richer debt market, that would create a more appropriate debt market. And then we could really start talking about the maturity of the debt sector across the African continent.
Interesting, you panelists, three of you, thank you so much. We appreciate your intervention so far. So let's take a few questions from our participants. And this has been spoken to in one or two ways, but I'm going to ask Dimieari very straight. So the question from Adesho Nibara is this: is the African foreign debt cycle a blessing or a curse?
Can you say that again?
Is the Africa's debt cycle a blessing or a curse?
Definitely not a blessing. What's happening is that we are taking in too much debt, and our economy is not robust enough to pay these debts, and it becomes equation of going back to the creditors to appeal for debt rescheduling or debt cancellation. That shouldn't ordinarily be the case. We should be able to go to the table like anyone else and discuss business other than coming every cycle to beg for debt forgiveness. So for us to be able to have strong economies that can manage these debts, we need to have more vibrant private sector. And this happens in the small and medium economies.
So if there's going to be, this is another question from one of our participants as well. And the question, let me ask Joseph this directly. So how do you efficiently and effectively hedge financial risk in developing economies with regards to FX-denominated loans and impending resultant effects of debt burden? Joseph?
So that's a very broad question, but I mean, we use, depending which financial risks you talk about, I mean, the investments we make in our funds, firstly, we do fundamental analysis to decide whether, they are attractive long-term investments or not. So on the credit side, we do very detailed credit analysis to de-risk the investments we make. And, we go through a very detailed investment process looking particularly at balance sheet metrics when it comes to the credit side. If you're asking about currencies, we hedge some of the currency risk, but again, we take a view on currencies. It's maybe just worth saying African currencies have actually performed very nicely in the last couple of years. Again, one needs to differentiate and can't talk about all African currencies in the same manner. But we would de-risk some of our currency investments where we were particularly concerned with a hedge. I mean, I think a risk, and it'd be interesting to hear Mr. Sanusi's comments later, but repatriation risk of currency is something that I think has caught a lot of investors, particularly Nigeria and Egypt,
Angola, Ethiopia, yeah.
And that's, I think we all look forward to the day when we can no longer be concerned about ability to repatriate currencies from markets, and that again will contribute to the development of capital markets. So, Boason, does that answer your question?
Yes, it does. I'm sure Elizabeth will want to say a few words around financial FX-denominated loans, the hedging risks, and all of that when it comes to this debt implementation for the private sector, credit bondholders, and others. Yes.
Well, I think we have to have liquidity, right? We have to have people willing to buy and sell these currencies. We have to have willing people to take the other side of the exposure, and to be able to have that, we need healthy capital markets. We need more competition. We need more market makers. We need more brokers. And if you look at, I always use the example of the tiny city of Zurich in a small country of Switzerland, where I started my career, there were thousands of brokers, tons of market makers making a market between the Swiss franc and the euro, which never really moved. And you go to the city of Lagos, one of the most vibrant metropolitan areas on the planet, one of the fastest growing populations on the planet, and you can count the number of brokers and market makers on your two hands. And I think what we need to see is the growth of this, the willingness of people to step in and be the first person to step in and say, you know what, yes, it's a little bit more volatile, but that's where everybody can play and come in there and really create that liquidity. And what we've done as our own market maker, we've built up our own book of liquidity. In the early days, it was very difficult because we were one of the few doing that. And as we've grown, we've given comfort to our customers and given comfort to investors who said, we're confident as it will be there in 2 years when we need to make that trade. We're confident that somebody will be there to buy the opposite side of this. Someone will be able to settle this derivative. Someone will be able to pay out on a forward. I think the problem we've seen across the continent is the fear that no one will be able to settle besides spot. right? And then we can only have spot markets because everybody else will evaporate. And I think if we didn't use debt to bolster up monetary policy, and if we did allow the free movement of capital, we'd see more entrants. And if we gave out more licenses, and if we let more players come into the space, we'd see a much healthier service, level of service, level of liquidity, and level of comfort to the private sector that needs this liquidity to operate.
I have one final question, as it were, to the panelists, and I'm going to start from Dimieari Kemedi. So, what is the role of Pan-African institutions in the entire debt implementation, whichever way it goes, on the African continent? Institutions such as the FDB, Afreximbank, the African Union, and others.
I'll start with the African Development Bank, the AFDB. Most of the credit that they've been extending has been going to sovereign governments to support budgets and other such expenses. This is not sustainable. This is not what will grow the African economy. They need to deal more with the private sector so that we can have a more robust economy on the continent. And of course, they are doing very well in terms of the credit rating they have, which is really good for attracting funds into the continent. But what is required is more money going to the private sector. And the African Union, of course, can work together with the African Development Bank and Afreximbank to address the unsustainable debt that we are now dealing with here. Nigeria and Angola, for instance, the amount of money that we spend on just paying down the interest, not to mention even the capital, it's just too much, it's unsustainable. So we need to come together and convince the rest of the world that we are serious this time around. We need to reduce our cost of government very, very drastically. We can't be running expensive governments like this and at the same time convince people that debt rescheduling or debt cancellation will not go into subsidizing that very lifestyle instead of growing the economy. Everybody wants to participate in Africa because this is the last frontier, but they need to see things happening differently.
Okay, we have a couple of questions coming from our participants, and I'm going to take that. My apologies. So let me just take this very quickly from Osborne. And Osborne is asking, Africa has been mainly used to borrow from the West, who often ask about accountability and transparency. So Joseph, I'm going to ask you directly, what are your views on African countries shifting to borrow from China, where there are the question where no accountability and other democratic principles are not considered?
Well, again, I would say there've been a number of shifts. So it's not just, it's not just to China. Private lenders now own more than 30% of Africa's debt. So that's been a huge shift as well. And I mean, I think one of the big successes, if you want to call it that, is the Eurobond market. You know, Africa's raised $55 billion alone in the last 2 years from the Eurobond market. It's attractive financing because it's very short term, and in dollar terms, it's quite cheap. But it's not linked to specific projects, and you know, often less questions are asked around the users of the Eurobond funding. But if your question was, is Chinese lending or private lending unconditional? It's not. You know, it's done with a commercial mindset, and you know, in that sense, you know, any lender expects, you know, does it on a commercial basis. Does that answer your question, Boason?
Yes, that's from one of our participants, and we have quite a lot of questions coming through. I'm just going to throw the next one from Farah Qureshi from University of California about this very lengthy question Farah, but I'm going to ask Elizabeth to try and chew this over. How do we differentiate on the previous debt programs, type of debts, and when they were accruing to modern debt that has been accrued by Nigeria and a few other African countries tied to infrastructural projects? So how can we ensure, for example, that power and growth from these infrastructural projects can benefit people at the local level and not just the multinationals?
I mean, this is the question, right? How can we change the status quo? And it's an incredible question, and we could sit here and write, 12 PhD theses on this. And I'm very interested to hear Your Highness's view. And I don't want to speak for gentlemen in his type of role, but I think it really comes down to who's in charge. How do who is making these debt agreements, and who is making the covenants and the terms, where it will be spent, what sectors of the economy it should be used for, who's keeping it accountable, even if we promise and say that we'll be using it for these things, is it truly being used for that? I mean, it's an incredibly complex question, and it really truly involves, more competition of those taking the debt. So if we have all of the debt for an economy centered on either one government or one major bank or one, private debt holder, then that's of course a problem we've seen everywhere. If there's more competition and there's more people that are available to participate in this, of course we'll see a more transparent use of that. And I think that's been the real problem. And again, not to keep saying the same thing, but I think when debt is taken and saying we need this, I mean, there are parts of the Ethiopian economy which are better than European economies. And there are some sectors and parts of the Ethiopian economy which are far worse. So how can we take one debt package to be used for Ethiopia? I mean, it makes absolutely no sense. The monorail there from the airport is far better than anything that I have in my hometown of New York City, and I left New York City 15 years ago, and I go back there and I still see that the transport to the airport far superior in Ethiopia. So how can we talk about it at one level? What we really need to see is to stop these monolithic debt deals. From these international organizations that come in and say one debt deal for all of these economies. These are incredibly diverse economies, and they're growing in a diverse way, as they should, and they need to be taken in a more private level. And I think, even in Zambia, if you're talking about the copper sector, it's quite different than the agricultural sector. Copper is having a very different year than tobacco. So, when you're looking at what that looks like in different parts of Zambia, and then over in its neighboring countries, it's a completely different question. And if we go back into history, we know that the borders of a lot of African countries were drawn arbitrarily. That's for the countries are operating in a very different space. Northern Nigeria is on a different level than Southern Nigeria. Lagos is very different than Kano State. Even in an outbreak of COVID and the effect on COVID, which was the original intent of this. So we just need to have more people holding the debt. And that's, I think, the way that we'll see different uses of the debt, and hopefully new ways of keeping transparency on the use.
Interesting. So taking from that, Joseph, the question from Felix, one of the participants on the show, is, can Africa, for the purpose of these debt issues, create a central debt management office that can actually screen the continent debt and assist in managing the debt to ensure that they are productive debts? A centralized clearinghouse, as it were, for Africa's debt, a central debt management office. Is it workable?
I would say that would probably fail miserably, and is not what's required. Again, each country has completely different debt metrics, debt requirements. I mean, Zambia, debt to GDP has doubled in the last 4 or 5 years. Yet Kenya, is doing much better. So why do you need a central debt management office to manage such diverse debt requirements across the continent? And again, I go back to my point. The creditor landscape is much more complicated these days. It's not just multilateral lenders and bilateral lenders. There is significant lending from China. It's quite capable of managing and renegotiating its own debt on the continent. But I'm guessing China wouldn't want to provide debt relief on its own. It would like to do that with Western countries and with multilateral organizations. And then on the private side, which is more than 30% of Africa's debt, good luck trying to coordinate that disparate bunch of lenders in the private market. And there, the instruments are open to restructuring, refinancing. There's a lot more possibilities than just a blanket debt relief that was much more appropriate and much more necessary 20 years ago.
Okay,
and
thank
again,
you, Joseph.
Yeah.
Joseph, just permit me, with due respect, we have to take one final question quickly for just about 1 minute, then we'll get to the closing remarks for this ASA's live webinar. So let me ask very quickly, the three of you, and give me about 10 seconds or so, and this is from Jonas in Liberia. There's a growing concern that the debt level of some of the African countries have almost reached unsustainable level. Yes or no? Elizabeth?
Again, there's so many countries in Africa. Some countries, yes. Some countries, no. But yeah, I mean, I think the cycle is damaging.
Cycle is damaging. Okay, Joseph. So unsustainable level. Do you have country specifics?
So if you look at Africa's metrics in a global context, they're actually lower. So I would say, yes, they're at unsustainably high levels, varies quite broadly from country to country, but it's a global problem. It's not just an Africa problem.
Okay, you don't want to name names. Okay, we understand.
Well, no,
okay.
I mean, Zambia is probably, one of the countries that's very challenged at the moment. Yeah.
Von?
The debt levels of Angola and Nigeria obviously have reached unsustainable stage. Something needs to be done about them, particularly the government's debt. Yet more capital is required in these two countries, particularly Nigeria, which is where I come back again to putting more money into the private sector so as to build a bigger economy, and then government can go for tax revenues instead of depending on debt from outside the country for implementation of projects.
A very big thank you to three of you who are my panelists. Now let's go to the closing remarks of this ASA live webinar. Ladies and gentlemen and participants, let's take a listen to His Highness Muhammad Sanusi II, the 14th Emir of Kano, and immediate past governor of the Central Bank of Nigeria. You have the floor, please.
Thank you very much, Boason. Can you hear me? Thank you very much, Boason. Can you hear me?
Yes, please, yes. Go ahead.
Okay, so let me start by thanking the panelists for a very enriching and enlightening conversation. I requested to make my interventions closing remarks, but I kind of regretted it because at several times in the course of the conversation, I felt like putting up my hand and just jumping in. The conversation was so interesting. Well, let me start, and I think I have just 7 minutes, so and there's a lot to speak about. I'll try to
please go ahead.
Okay, so let me start by saying, first of all, I think we do understand that in most of the African countries, you've got a fiscal deficit problem. You also have a balance of payments problem. Okay, so while people think it is time to look at how you can reduce the deficit, this is no time for consolidation. Okay, we all understand that any attempt at this point in time to cut spending is simply going to throw many of the households into deeper poverty. It's going to you can't increase taxes on the private sector at this point in time heavily, because that is going to affect private investment, and you're going to go into a self-fulfilling cycle of economic regress. So we must do something about the level of debt service obligations. We must provide a certain relief to the country's balance sheets to free up the cash flow to maintain the momentum to go through this period. So I think this is something that's well understood. That's what the IMF and the World Bank have done. That's what the DSSI is about. And private creditors also need to look at that. I don't think the countries are going to ask for a moratorium on private debt, but I know the African Union is looking at some instrument that will provide liquidity to the countries while making sure that debt obligations are being met with private creditors. But going into my own intervention, let me take this from an angle that's not been taken in these conversations. I spent most of my life in banking as a risk manager, and I must say I'm absolutely appalled by the kind of risk management that's shown by international creditors when they lend to African countries. Many of what I find is it seems very easy to just invest in a bond if it's given a return of 10, 11%, because you've got all these negative yielding instruments in the international markets, and you're relying on the fact that the countries cannot afford to default. Okay, you're not looking at where the money is going, you're looking at the financial condition of these countries. I hear these numbers about debt to GDP ratios, and as a credit officer, a debt to GDP ratio means nothing. A debt to GDP ratio of 30% for a country where tax revenues are only 6% of GDP is not the same as 30% debt to GDP for a country that has 50% tax to GDP ratios. Now, you've got all the signals that have been going on, all the alarm bells have been going on for a long time, countries spending a significantly high percentage of their revenue on debt service and then piling on more debt. Okay, now if I were sitting as a risk manager in London or New York, I'd look at those numbers. The second thing is, you know, COVID is a black swan event, and we all understand what it's done. But the reality is, I don't think there is anything that Africa is facing now that was not known, that was not predicted. After HIPC, we had this story of Africa Rising. And the Africa Rising story was driven by two things. In the first phase, it was driven by rapidly rising commodity prices, okay, basically off the back of China and India growth. After that, after the period of rising commodity prices, African growth was fueled by debt. As far back as 2015, I did a presentation, and as far back as 2015, 2016, most African countries had gone back to debt to GDP ratios and debt service to revenue ratios that were much worse than they were pre-HIPC. So with or without COVID, this was going to happen, okay? Something was going to happen that, questions that were supposed to be asked were not being asked. Countries were just piling up debt. Now, some of that debt is domestic, which means at least for now, those countries don't have a risk of insolvency because they're issuers of that currency. However, there's a risk of inflation, there's a risk of devaluation, okay? And they've got to be careful with printing too much money, okay? But I think it's important to know that many of these, what we're seeing today is, yes, COVID is a wake-up call, but for the last 5-6 years, if you're looking at the balance sheet of African countries, you'd have seen that we were already back to where we were before 2000. And somebody should have been asking these questions, okay? And these questions were not being asked. China, we talked about China. I don't know, Boason, you may remember when I was governor of Central Bank in 2012, I did an op-ed in Financial Times where I raised an alarm about the nature of the relationship between China and Africa. It was very controversial. But again, you know, I'm not surprised that we're at this point. I mean, it is something that everybody could see. There was too much debt going into projects that had no connections to economic growth or economic development. And, you know, and we're in this world where so long as you had GDP growth of 5-6%, nobody looked at where that growth was coming from. Was it coming from just debt that was going into revenue expenditure and overheads and consumer spending? Or was it going into real productive capacity? And you know, I think we're not looking at the right levers for growth. Now we talk about Africa growth of 5-6%. To be honest, if you're looking at development as a long-term, you don't need a 7% rate of growth. If your economy grows at 2.5% year after year, the law of cumulative growth says you'll double your GDP in 30 years. Okay, and you know, in 100 years, you'd have multiplied your GDP by 11.8 times. Now that is enough to transform nations radically. Okay, but you know, we get carried away by these 5%, 6% growth rates over 2-3 years, and then you have this, you know, these boom bust cycles, and you're back to where you started, rather than looking at what you're actually doing to improve the productivity of your human beings, the human capital, which is extremely important, and the productivity of your economy. Now, if you take Nigeria, okay, if we just focus on increasing the supply of electricity per capita, looked at bandwidth, and invested more in education and healthcare, you would have stable growth of 3-4% every year. And that is more than enough to transform the economy over a 10-20 year period. Okay, but if you continue relying on these this government spending that's fueled by debt, and also commodity prices that are very unpredictable, you're going to keep going up and down. And Nigeria is just one example, but there are many across Africa. Now, the situation, as I see it today, is that the DSSI being worked out by EU is a great thing. I think the idea of setting up some mechanism where you can pay private creditors while keeping the governments afloat and giving them money is also excellent. But I think we also need to ask what we need to do going forward, okay, and how we need to attack the balance of payments deficit. Clearly, I've heard Nigeria mentioned. The Central Bank of Nigeria has said it will go to a convergence of exchange rates. I don't think there's much risk in Nigeria of not getting capital out. I think we'll get to that convergence. When we get to that convergence, there will be a devaluation, but that's a price we have to pay. And I think that would be a very good signal, okay, for reducing the current account deficit. Because the reality is, if you have a weaker currency today, if you look at the tradables, look at rice imports, how much you spend importing food, for example, that can be produced locally. How much we're spending in the tradable sector importing textiles products. We import shoes, we import bags from China, and we are a big leather producing country. There's no reason why Nigeria should not be producing its shoes, its bags, its textiles, its garments, its food, and that is going to be a major improvement to the balance of payments position, and that is the route, I think, towards reducing the fiscal deficit rather than hitting the household and private sector balance sheets. We also have to look at some of the more inelastic areas of demand. Take petroleum products, for example. The Dangote refinery will be good news. I don't know how long it will take for it to come on stream, but we do have 4 refineries. What does it take to get those refineries producing and reduce your dependence on petroleum imports? Now, if you can, with a flexible exchange rate regime, improve your tradable sector, if you can reduce your dependence on imported petroleum products, then hopefully with stable oil prices, you should move back to a balance of payment surplus. And that should then be the route towards redressing the weakness in the government balance sheet. The final point I'd like to say is, I think Von made this point and Elizabeth made this point. We lend money and we don't know where the money is going to. And from a risk management perspective, if I were a bondholder going to put in $1 billion in an African country, I'd be interested in where that money is going. And if I understand that there is an execution risk, and I would ask, what structures do I need to put in place to follow up and make sure that there is actually execution and implementation of these property or telecoms projects? You don't just put in the money and sit down and wait. I mean, we all understand that when you deal with counterparty, you look at the risks you're running when you're dealing without counterparty. For some counterparties, I mean, if you're in a bank in Nigeria and you lend to Shell or MTN, you don't follow up. But if you lend to a middle market, an SME, you actually know you have to put in an extra effort in following up to make sure that your loan comes back. That's why you are entitled to charge a higher rate of interest. So given the kind of returns creditors are making on Africa, I think a little bit less laziness, a little bit more effort in following up the money, making sure it goes into the sectors, helping see that these projects are actually executed would be very helpful to avert a recurrence of this situation. But certainly for anyone to say at this point you won't do a debt standstill or you won't give any debt relief at this point in time, you're basically sentencing many of these countries to death. It's simply not possible. They will default anyway, because with the levels of poverty, with the people being thrown out of work, with with SMEs suffering already. If you hit the government's balance sheet today without looking at the external balance sheet, what you're going to do is impose all that cost on the household and private sector, and that would throw us into a recession that we cannot come out of. So like I said, I had many points, but I don't want to take too much time. I think I've actually taken more than 7 minutes.
I'll give you 2 more. I'll give you 2 more minutes, Your Highness.
Okay, so I think just to round up, I would say that I agree with most of the points, especially points made by Elizabeth have been extremely fantastic. I think this is a great opportunity for us in Africa to look at, yes, we understand that this is where we are and we need to do this, but it's time to look at how we got here, okay? Subsidies that we're paying that we should not have been paying, okay? Not going into cost reflective tariffs, say for example in the electricity sector, okay? Borrowing long-term and not following up on infrastructure projects. What have we learned from the mistakes of the past so that we do not repeat that going forward? And then also for the creditors themselves to take a step back and say, did they ask the right questions that they needed to ask? China the relationship between China and Africa is one that is filled with great opportunities, but also fraught with risk. Okay, at the end of the day, we Africans have to decide what we want from China. If we ask the Chinese to give us loans to build roads from nowhere to nowhere, and yes, I heard what Joseph said. And you know, but the Chinese loans are commercial, but not in the sense of your loans. I mean, the Chinese will give you a loan to build a road, and to be by Chinese construction companies. It will be done by Chinese labor. So even if they have a loss on the loan, they probably have made a lot of money on the construction side and on the supply of equipment side, and they've made huge profits. They probably have made more money on profits than they're going to make, that they're going to lose on the loan. So they're very smart in that sense, which I think a typical bank does not have that alternative. If you lose the money, you lose the money. Whereas they have a way, and that's why I think the Chinese need to be far more accommodating and far more flexible than they have been so far. And they need to sign up to the DSSI, and they need to recognize that yes, they may say they're losing some money on the loans, but they've made a lot of money on the infra, on the supply of equipment, on the labor, on the management fees, and so on, that were financed by that loan.
Your Highness, thank you very much for stopping just at the right time. I was about to run into some debt here, and I don't want to get into any debt crisis on my hands in terms of time management. Elizabeth, Gavin, and others, Stephanie, are watching my time. So thank you very much, Your Highness, the 14th Emir of Kano and the Central Bank Governor of Nigeria between 2009 and 2014. Thank you very much for bringing this ASA webinar to a close. I'm sure there are a few other questions that were not answered during this event. This will be answered. Just follow through on Twitter feed of ASA_Africa. That's where some of these questions will be taken. Thank you very much. And my panelists, let's draw the curtain. Let me say a formal thank you to Elizabeth Rossiello, who is the co-founder and CEO at ASA. Thank you very much for your time. We appreciate your being here. Joseph Rohm, the managing director and fund manager at Adventis. We appreciate your coming through on the program today. And of course, Von Kemedi, who is a co-founder, Nigerian entrepreneur, and the managing director of Alluvial Agriculture. Thank you very much.
Thank you.
Great. I can see that we have our pool results there. It looks like the second option is the best approach from our participants: forgiveness or cancellation with conditions. What you call the stick and the carrot approach, which is the use of proceeds, transparency, speed of execution. As His Highness says, Muhammad Sanusi II says, there's a need to differentiate what is going on in country, on a country by country, and perhaps project by project basis. That has the most vote. That's about 56% of our participants. Thank you, everyone. And a big thank you to the team at ASA for bringing this together. ASA is continuing to supply liquidity and treasury solutions for growing transactions across Africa and around the world. Visit tradebfx.com. We want to learn more about what ASA is doing on the continent. And just a reminder to my colleagues who are journalists attending this ASA Live webinar, if you have further comments or questions or clarifications, please remember to get in touch. We can arrange a quick follow-up for you. This has been a Chatham House Rules conversation. Thank you, everyone. Do stay safe. And of course, we wish you all the very best during this very interesting time we live in. I am Boason, and I will see you next time.